Thanks again, for joining this, the Lakes at Renaissance Park investor meeting Q1
Mm.
2021, April
Right.
29, today, and presented by Vinney. Smile Chopra, I smile a lot. CEO,
Mm.
and also I'm the CEO of Monil Investment Group and Monil Senior Living Group, which is a brand new division of our company, doing
Uh,
very well. And of course, we bought this property with our partner, JT Capital Group also.
mm.
Tonight's agenda is going to be executive summary. I'll be giving you updates. Then we'll go through the financial analysis, then the property overview, business plan, asset management team, all that. And
Mm.
then new Monil opportunities. If anybody
Mm.
would like to find out, we'll talk about that a little bit and questions and answers after
Right.
that. So, executive summary, our daughter. Oh, by the way, just to let you all know that, Lakes at Renaissance, we
Mm.
had hired a company called, oh my gosh, Carlton.
Mm.
Carlton Partners. They were
Mm.
not able to cut the mustard for us. So
Mm.
that's why we changed to Bell Partners
Mm.
management team. And I just went on their website. This is bellpartnersinc.com,
All right.
top multifamily asset management firm, a
Right.
proven track record since 2002,
Mm.
not bad, 19 years, and they have completed more than 17.3 billion dollars
Mm.
in apartment transactions. So they own some properties also and
Okay.
and then
Right.
they manage others, like ours. So we are very happy with the senior management team. I know Monica wrote it here.
Right.
That's our daughter, Monica, our asset manager
Right.
for this our company, VP of the operations. So she just sent it to me today at 3:01 p.m. We are
Okay.
extremely happy with the Bell team. That's that Bell Partners and
Right.
the Rockstar regional manager Shane.
Yeah.
So she meets, I meet, and other team members meet with Shane a couple of times, and then we keep it all occupied. Occupancy as of occupancy is at 94.8%. So congratulations, and
Mm.
pre-leased to 95.8. That means we have a couple of more residents waiting to come in. That's the
Right.
pre-lease number. Renewals for June, because we go 3 months ahead. So May, June, 60 days, 16 renewals total are coming up, and we'll be able to, have 14 undecided so far. But we are always having our leasing agents, our managers to start talking to them right
Right.
now to entice them to renew. That's the key thing, right? And then July, we have 29 total renewals coming up, still pending. So that's where our focus is. Even in April, we are looking at June and July so that we could get, hold of them. And then if they are leaving, which will be fine, we want to get the new people come in. Renewal rent, a raise in rent, that's a good thing. So
Mm.
Tia, our community manager, is sending renewals manually for the
Mm.
$300 increase in
Mm.
rent for July. So
Mm.
2 bedrooms are there in that category. She's sending it over there. Keep up with the hot market, because the market is hot. As you know, Austin is just blowing like crazy. Even the single family home, people
Mm.
have to pay 200, 300,000 more just to get into the home. They are over the asking price.
Mm.
Influence people to leave so that we can update. So actually, we are influencing people to leave if they can't pay $300 increase, so that we can update the 2 bedroom units, as
Right.
our business plan called for upgrading the 2 bedrooms. So we don't want to evict them or anything. We want to see if that, as they come open, we will start doing the updates, and then we'll increase the rent. If they decide to stay with the 300 increase, we will have a significant increase in the income, of course. And if they decide to leave, then we'll be able to renovate and command the higher pricing.
It's
That's
$300. What is the base for $300? What is the current rent for? Which is
I think we'll see that. Sure. I think it's right at about 1100 to 1200, depending on, right, on this flare plan. I think we have 7 or 8 floor plans,
Right.
Rameshji. So renovations on the far. This is a really good one. 2 of the 5 units are leased. We got some money at the closing from the seller because there were some fire units, 3 of them actually. So 2 of them, one is still available. And first floor, we got 1,502 market rent. So not bad, not bad. 1,502, and the fire units have been renovated and are commanding high prices due to the hot Austin market again. Small amount of vacancy. Apartment 1015 was a non-revenue unit, but we knew that when we calculated our underwriting that this will be able to put it back together and then have that money. Oh, the rent was this one. Oh, there we go. Ramesh, you just asked us. So
Yeah.
this was, I think, 1 bedroom. So it's 1090 and now it's going for 1502. So very good, which is about this rent increase. That's even more than that. Oh, yeah. This much LRO algorithm pricing just increased the rent by $60 in and last week due to the small amount of vacant units. What is that algorithm pricing? Software is there and it looks at all the rents and availability of vacancy in the marketplace where our property is, and next day rents it sets itself. So it's a very good AI, artificial intelligence, which kind of gives the homeowners, I mean apartment owners like us, to fluctuate the rents depending on how the traffic is, how the vacancy is, and how other things are working. Apartment 3, third 3 bedroom was an already renovated unit, which is at this, and after renovation went to 1675. So that's pretty good. 1675 right there. The Morgan is charging slightly, which is our competition, by the way, slightly less than ours, Renos, but we have more green space, more parking spaces, and we are not painting the cabinets, which they are doing. So we are kind of renovating them. That's why. Then Monica wrote also our plan to place 2 renovated 2 bedroom units is available online as seen in the fire expected more and more renovation getting higher rents, which is our business plan. Bell management has helped us a lot in cutting the costs on renovations. We are very proud of Bell. So glad we just sniffed it out in 2 months. I think that the Carlton cannot cut the mustard. So we act very fast. And then we got now Bell Partners. They're also managing our Bentley in Florida and also our Princeton Park in Florida. And hopefully I'll be buying in Tennessee. I'm looking at some properties there. Multifamily will be offering it to Bell if they can manage it for us there. We'll see. So we instead decided to piece together with multiple different vendors and Bell overseeing it. This will cost efficiency, much less than what we were expecting for renovation. So we're always looking to reduce the cost. 5 units able to do with 511 completion. Paint first, then granite, then backsplash, and then flooring, light fixtures, plumbing fixtures. This is 4 2 bedrooms and 1 3 bedrooms. So we are going after those, 5 units to see how the rent bumps will warrant us to go for next 5, next 10, so on. So 2 units for August have given notice and we can renovate those. And then Monica writes that, delinquency collections, delinquency is high. Holy cow, look at that. 162,000. So COVID has hurt us. Every apartment complex is hurt like that. So our delinquency is this much, with 70K of that is 90 plus days. So we hardly will get that money, but we are trying our best to get the balance, about 92,000 or so. We have submitted renter residents that have not paid to the taxes relief, rent relief. which we are helping it. All our properties in Texas, in Houston area, we have 3 right now, which we are also doing the same thing. We have sent them all 60-day notices so that we can file evictions on May the 7th. So now moratorium is going away. Hopefully, with the COVID and the relief of $1,400 check, all that. So hopefully we'll get better in there. Although the Austin market is hot, we are still dealing with delinquency from residents. Although we have given them non-renewals at the moment, we cannot evict because we have given them. And then capex maintenance, asphalt, parking lot, we are trying to get bids for that on a phase 3 and should be wrapped up. And then ordered new pool furniture, time for the summer. Then we also got working on plans for clubhouse renovations. That's a big one. We want to do so that we can boost our property to compete with the nicest buildings out there. So I'm going to take you all out now to the financials, and that is going to be here in my Excel worksheet. Can you all see it? Yeah.
Yeah.
Okay, wonderful. So this is Bell Partners Inc. accrual package. It's on accrual basis. I want to say that it's not actual accrual, meaning that it consists into the incomes coming in and the expenses going out on a whole spectrum. That's all it is. In actual, what it does is it pays the bills for that month only and does not account for the future bills, which then it's like lagging. That's what I was finding from the accounting. Many times the bills for last month won't be paid until next month and so on. So this is accrual basis. Most of the property management, companies use accrual basis. And you could see that it started from September when we bought it. Of course, we had, this was money given to us when we closed in the middle of the month. And then this is the gross potential rent. I want to say that it's the gross potential rent if everything is hunky-dory, like when 100% occupancy, no delinquency, no concessions, we'll be able to collect this much. We should have collected this much, but then we take out the concessions, vacancy loss, and other rental losses. We take out, that's delinquency, by the way. Other rental losses are delinquencies. So we did lose, quite a bit. I mean, we could look over here, 101,000, 110,000 in vacancy, and so on. But still, since we purchased it, we collected 1.577 million, which was economic occupancy even during COVID and everything of about 86.68%. So not too bad. I mean, we are this was the best month for us somehow when we bought it. Maybe they camouflaged it. You know how it is when the seller sells, they pack it up and, give us a better rental than it really is. Then we take out, of course, the expenses. You could.
But uncle, what was the expected amount? What is the expected rental? The expected occupancy. What is the target?
Oh, target is 95%. We always want to go for 95%. Yeah, 95.
So
and
we're
that's
quite a bit off.
I don't know if you joined right now. I shared on the PowerPoint. Monica was saying that we are almost there. Isn't that right? She was saying we are at 95.8 pre-leased. And as of, last week, we are at 94.8. Now, remember, all these financials are up to end of March. See, so that's for the quarter, right? Are we okay?
Yeah.
Sure. Thank you. So then, we got, of course,
against if there was no delinquency and occupancy at 95%.
Yes. Then this will not be taken out. These things, and then it will be 1.819 million.
Now it is 1.57, right? So we are down to about 15%.
Exactly. Right about 15%. You're right. Yes.
We come to 15%. I'm just ballpark,
So true. And then we also have, now that's on the rental side, by the way, but then we go to the other income side, right? other income, which is, all the administration fee, pet fee, this kind of fee, that kind of fee. So that's by each month how much comes in. They keep on logging it and depositing into the bank. And then this is our utility income, like water, trash, gas, sewer, all that. So we collected 127,000. So we add these two together to come up with this number, right? Everybody with me, right? So that's this one for up to so far. Then I also went ahead and did it for Q1 also, so that our investors can see that in the last 3 months we have, collected. I should have done this also. I don't know why did I do it. I'll just copy and paste it and see what happens. There we go. So we got right at about, 86.42% there. So that's where I'm going to save that also. It's right there in my folder. So let's go down to the expenses. We got all the utilities expenses, maintenance, repairs, alarm, cable, landscaping. I mean, you name it, right? Make ready, turnover, payroll, marketing. So all these expenses so far, we spent almost 610,000. Sorry. Oh boy, 610. And for the 3 months, we spent right at 295,000. That's for the Q1 performance. So then subtracting the two gives us the net controllable profit, they call it. And then we take out the management fee, insurance, property taxes, all that. So then we are left with the total operating expenses, and then the NOI, net operating income, is this much right there, right?
As
697.
against budget is 700,000. And what
Right.
was the budget for this period? How
Yeah.
are we against the budget?
Against the budget, I'll show you in 1 second. If I may just show this one, I'll go right here, the budget comparison in 1 second. So actually this was for the whole up to now, and this is up to this quarter, right? And then we take out the mortgage, interest and everything. So that's the net profit and all. But let's go to budget. So now in the budget column, this shows us only for the current month, the actual and then current month budget, and then versus and budget. It shows us the variance, and then it shows the PV. I think prior year is not for us at all because we didn't own it, in April, but in March. So then we go to the current year actual and current year budget. So let's go here. This is more meaningful for us. So essentially, Bell Partner was waiting to say, okay, our current budget was this, we reached this much, right? And they came to us in, let's say, December, right? So the previous company, what's that? Carlton Partners were there. So they just kind of put the budget kind of low, you know how it is. And anyway, but this is what it's the real numbers right over there, year to date for the 3 months, and then the year to date, what their budget was. They want to look better, right? So that's how they do it. And then we go other incomes for the budget for this period. We got more actually money in the utilities income and in the other income. So that was really good. Our budget was this much, we collected this much, right? And then we could go to controllable expenses again year to date, which is utilities. I don't know why they put so low. I don't know how they figured it out or whatever. But, we did spend more here. As you can see, we spent almost 295 instead of 253. So $43,000 difference. We spend more. Oh, there it is. What am I talking about? Right there. The variance is shown right there. So we went ahead, or we lost that much, or so as to speak. Then non-controllable expenses, management fees, of course, right there. Then we got the insurance, we got the property taxes right there. And that's what is the current, and this is the budget. You can see that I could see this property management company, they want to put lower budgets and come high to look good in our eyes, So again, budget is designed to see if we have a track record, right? We don't have a track record of last 6 months, I mean, of the 2020, because we bought the property in September. So almost 9 months, we don't have any, track record from the back. But anyway, net operating income, a little bit higher, and then we got the now this is the capex. So interest expense is the mortgage, which I showed you over here. I could do it here too, but it's the same thing. So I showed you all the interest expense here. Where is that? There it is, interest expense. And that shows the net income. But in their budget, somehow we are asking them to bring it below the line, like just show us interest expense, net income, and then capex and other items should be below the line, right? So let's just go back. Any questions on this one? Any questions?
Vinod, I have got one question.
Please. Yes.
You see, your management company may be making their own budget from a running budget point of view, because what they'll be running on day-to-day basis and making a budget out of it, right? Quarterly budget of expenses which they expect and what they're really spending. It's a very good comparison to find out how they are doing.
Totally.
But as an investor, I would like to know that I have invested X amount of money, right?
Right.
And on which you are expecting to give us a 9 or 10% or 8% or whatever is a return.
Right.
It naturally come out of the income, right? No, nobody, because you have to pay the bank loans as they are, and after whatever left will be this 9 to 10%, and at the end of it is the profit by selling the property, right?
Equity gain, right?
So in 1 year, budget vis-a-vis the real expenses totally all put together should leave you behind about 10 to 11% for the distribution.
Not really. If you look at our prospectus, Rameshji, in the first year to buy this property, there were 16 other parties who wanted to buy this property, right?
Right.
So it did not cash flow that strong.
Yeah.
And we allocated it from our monies that we'll be using part of the money to give our investors preferred returns. Yes. So
please.
Yeah, so that's why it won't give that 9 or 10%, but it'll give like maybe 6.51. Maybe I saw, maybe I should remember that again, but it's going to be fine because we'll be able to give our investors the promised returns. If we don't do it, if we couldn't do it, it'll be deferred. We call it deferred, right?
All right.
Yeah.
Okay.
Totally. But our investors will always be the first ones because they are Class A members, right? Members get paid first from the operation of the property.
Right.
Yes. So let me go ahead, and it's about 27
I don't
minutes.
understand, Uncle. I don't understand the deferredness. Could you explain that again to me?
Oh, yeah.
What is deferred?
Yeah, I would love to. Deferred payment means that if we miss a quarter of giving 8%, I think it's 7. At 100, it's 7. At 200, I think it's 8. And at 500, it's 9%, right?
Right.
So if we miss one of the quarter, if you take 8% in the middle, divided by 4 quarters, right? So 2%, 2%. But if we miss one quarter, not giving 2%, we gave only half, let's say 1%, then that's tacked on to the next in the future. So,
but how will you get it in the future?
Yeah, in the future, it will be if the property is doing really well, right? More cash flow is coming, then
but that is just futures. But that's again, Uncle, that's futures. You cannot predict any of that.
Oh yeah, right? Nobody can predict it. So the key thing is any kind of deferred, cash flows. If we refinance it and there is more money coming, for the new loan into the property, then they will get, our investors will call it truing up. It's called truing up, right? Or if we sell the property, right, in 2 years, then there is a big cash flow coming in, then our investors will be paid first to take care of the missed cash flows is the word. And then we'll give you the IRR. That's the other thing, because it's 50-50 after that. It's 70-30 before that. But then after we reach the IRR for the investors, then we go 50-50, right? Just like our package said legally, right?
Yeah, I don't understand how you're going to catch up on the deferred. I'm still confused.
Okay, well, deferred, let me just say this way in simple terms.
Vinney,
property is not making the money, right? We'll defer it, whatever percentage it is, and you will be taken care of. Just think about that.
So, Vinney, can you hear me?
Oh yeah, please.
Hey, Shiva here. After a
Hi,
long
Shivaji.
time, not
How are
been
you?
able to join. Yeah. Hey, is that how the deferral was calculated on the Atlanta property on the missed?
In Atlanta, I'm so glad you said that. What happened is you're right. It's the same way, but the percentage is the same. The split between the deferral, cash flow, or the equity gain is the same. So we asked some investors in the previous years also, would you like a capital gain on your ordinary income, right? So if I give them truing up of the cash flow, it will show up in their K1 as the distribution, which they have to pay regular income. But if you take it as a long-term capital gain, that helps the investors. So that's why,
God forbid, if we did not, if like the other gentleman asked, if we did not get the deferral for until the time we sell, then there is a choice whether you want to take that as a capital gain or a deferral.
In this case, there is no choice. We have to true it up. The reason is it's the different structure with the IRR.
Okay.
With the IRR.
Good to know. I have not been on this situation with you, so I'm glad to know.
I'm so sorry. I can't explain. But the thing is, deferral means that if we missed a quarter or a percentage of the cash flow, any time in the future from the property, if we get more cash flow than what we need to disperse, we will disperse that and catch up for the investors. That's what that means. So you don't lose the cash flow. It's just that you didn't get it in that quarter, but you will make it up in the future quarters or at a waterfall. We call it waterfall, which is refinancing, or supplemental loan is another word, or sale. Hanji?
Yeah, understood. But what I was trying to understand is this is not how it was done for the earlier
Atlanta. No,
deals.
it was not.
Okay, got it. Thanks.
Totally different, Hanji. Atlanta was very different, and this is entirely different. Yeah.
Got it. Thank you.
We know, just in simple terms,
Hanji.
Let us say arbitrarily that the payout is 10%, arbitrary number, right? Right. But you are giving 5%, again arbitrary at this point of time because of the pandemic and recoveries are less. That means there's a carryover of 5%.
Correct.
Right? And this carryover can continue because of pandemic for next 2-3 years. We do not know how long it will be.
We don't know, Hanji. Right? Yeah.
So every year it is accumulating.
Exactly.
Next year also giving 5%. Next year also giving 5%. So almost 15% is a carryover, right?
Hanji.
So where does this money come from to give this 15%? Only by sale? Just listen to me.
Only by refinancing or sale.
So,
because the money has to come in, right? From somewhere.
And listen to me. You had projected that at the time of sale, we should be getting 50% on the equity on 1.5 approximately, right? And that was the profit part of it. Now, if you're carrying over this 15% to be recovered from the sale, right? And that is coming out of that profit, then my recovery at the time is only 30-35%. And therefore, my total expected return of 50% in the year will not, in the overall per year, may not take place.
Okay, now let me put it this way. You're 100% right what you're saying. See, the thing is, the property...
circumstances. These are the unfortunate circumstances we're going through. But
yes,
we should bite the reality that expecting a 17% per annum return, which was earlier thought of, right,
yes,
promised by you, may not fructify.
may not happen.
May not happen. So one should in their own calculation at home should see that the 17% may not be happening. You may be getting anything 10 to 12%.
I don't know 10 to 12%. You're right, Rameshji, but definitely you are 100% right. This is the property, and that's how, the cash flow will come. COVID, didn't help us much, definitely. And hopefully it will not hurt us. To be truthful, in this property, I'm more positive than any other property that I have, right? Hanji, ha. So I will not worry right now, but if we miss the quarter or something, then we should worry, I would say that way, right? But the reason we bought during COVID, in Austin, sorry, because of the market, Hanji.
Right.
And you know what? Somebody told me, I don't want to say that, but I'll just let you know right now. We got for 112,000 a door, 308 units for 34,750,000. I'm underwriting right now another property just half a mile away from this property. Guess how much they want?
I don't know.
154,000 per door.
All right.
So 154. I'm not saying that you will, claim that from me, but 154,000, very similar vintage and everything, times 308, that's 47 million. 47 million. And the broker said, Vinney, you bought it at the right place, at the right time, because the market has just gone berserk in the last 6 months. So I'm happy that we bought it, to be truthful. Yeah, Hanji.
That is, that is great to hear, Uncle.
Hanji? Yeah.
That is great to hear, Uncle. But
sure,
it's only the cash
flow.
I mean, so we were expecting as an investor, this first time investing with you, Uncle. So we were expecting
totally
return on a quarterly 100%. Basis. So unfortunately, we're not making that. Is that what I'm hearing? That we're not going
Not really. We are giving full cash flow to you all and everything. Nothing to worry about. Maybe next quarter, if we have less cash flow, we'll have to let you know, right? But we'll be giving you monthly updates and everything. But at this time, nothing to worry. Nothing to worry at all. And, the key thing is also, see, remember, NOI is one thing. We are increasing the rents, which we knew that already, right? So that's going to bring more net operating income at the bottom line, and then divide that by the cap rate. So NOI increasing and the cap rate decreasing, that's where the valuation comes, right? So hopefully next year it will be worth 47 million. I mean, no, we paid 37. How much we paid? 37,850. Yeah. 34,750, sorry.
Right.
And I'm looking at 47 million. Oh my gosh. I mean, maybe next year we'll come to the investors and say, let's sell it. Let's sell it and make a lot of profit. Why not?
Yeah.
Haji? This is real truth. I could not believe it when the broker told me, Vinney, what are you talking about? You got it a very good deal, at that 34,750 divided by 308. And he says now it's going for 142 to 150, 162, I think he told me. He says approximately 150, whatever number I gave you all. Yeah, so it's a good thing. I like it. Well, I definitely want to take a moment. Thank you so much for interacting with me, because that really makes me feel, good. I just want to take a moment, to say,
what is the payout for this quarter?
Andy, what is it? Oh, same what you got last quarter.
100%.
Hanji, ha. Yes.
Okay, that's what I want to.
Yes. Okay. Definitely. And I do want to mention, I know a lot of people are asking, Vinney, where are you going with the senior living and everything? It's going very, very well. We are expanding like crazy now in Virginia, in Florida, into Missouri. We are going to, Texas. Actually, right now, our people are there. So essentially, I want to show you all just a little bit something here. Those who are interested to find out, we are coming out with a Monil Multifamily Fund investment summary. It's getting ready and we are about there. It's a fund. So instead of buying only Austin deal or buying only Princeton Park, in this fund of $50 million, we'll be diversifying the fund. So we'll be buying different things within the fund, which will be better for the investors. Because if some property is giving less cash flow, the other will catch up, right? So we can give out to our investors what we projected. That's our main purpose behind it. Diversification, lots of opportunities are on the horizon and in the pipeline, and investors entering later do not dilute early investors. That's the best part about this fund, that they will be able to get, their cash flow, what we are saying. And then also there is one thing we are doing. A lot of my investors are saying, Vinney, when you sell, you capture the depreciation that we took. And it's a huge tax bill to us to pay the taxes on that big phantom equity gain. So that's why we'll be having two options in this fund, to just take the cash flow with no upside, don't have to pay taxes ever, or you could take the lower cash flow plus the upside. So that will be two of them. And we'll be buying conventional B class, just like we bought Princeton Park or we bought Austin deal. I'm looking in Tennessee right now. I'm looking at 3 other places right now. If I get a good deal, I will jump on it, right away. Of course, we'll be buying Cape Coral. I just mentioned it to Rameshji. That is the property we already built, and it's doing very, very exciting to catch it when it's on the upswing. We can catch it $1.5 million less right now, because when we increase the occupancy, it's going to go higher and higher. So that will be the second thing. We'll be purchasing a lot of these into our fund. And then ground up construction, like we did, many of the investors listening, they are already in my Punta Gorda, in Williamsburg, in Palm Bay, in Sebastian. So we will not be doing those separate anymore. We're going to be doing it within the fund, because we only need that money just for 12 months to build it up. So we are having so much trouble getting these finances, loans, and things like that. So that's why we decided we're going to do it all within the house. And then mid-tier name brand hotels. So I have another partners, a group of them, millionaires, multimillionaires in the Bay Area, who love the hotels. So that's where we just bought $6 million in December of 2019. It's worth 11 million today. 11 million, $5 million increase, because we got lucky and the medical staff chose our hotel, Hilton Garden Inn in McAllen, Texas, to live in this hotel. So we never went into loss. So which is very, very good. So that will be all these 4 things we'll be doing. I would like to just wrap it up by saying thank you to all of you. And these are just getting ready. It's still, my team is working on it. Our whole value team working very hard for you, into the fund and all the different things. And then I'll just put that, close this up here. And if any more question answers are there, I would love to answer. I think it's the last slide right over here. Huh? So please ask me any question you might have. And again, thank you for having the confidence in me for the last 14 years. I'm still going strong. I'll be 70 years of age next year. I'm very excited to be where I am in my lifetime. And next 10 years, I'll be right here because I'm very passionate about senior living investing for our millennials and seniors and build lots and lots of ground up constructions and all. Huh? So please, I'm right here for you.
Okay. Thank you.
And thank you so much.
Thank you, Uncle.